basically, what I'm going to do is to start out with some general observations on what we mean by financial regulation, why we have financial regulation. Then to go on and look very briefly at Dodd-Frank, and finally to end up with a number of alternative proposals that are currently being discussed in Congress, basically because nobody actually believes that Dodd-Frank will ever be finished as formal regulation, and increasingly people are under a, I think, very sensible belief that Dodd-Frank really does not address the difficulties that are being faced by the financial system. And then finally, at the end, hopefully if we have time, we'll look at a proposal that Minsky put forward in, I think it was a year before he died, dealing with the way that he thought we might deal with the difficulties of banks that are too big to fail and banks that are subject to the kind of moral hazard threats that come from deposit insurance. So if we look at the idea, what is prudential regulation for? Okay, everybody talks about prudential regulation. Well, just exactly what is it? Well, we know what being prudent is. Prudent is not taking a whole bunch of risks. But beyond that, if you look for formal definitions of prudential regulation, they are extremely difficult to find. So if you look at the UK regulatory authority, they said to ensure safety and soundness. Well, what does it mean to ensure safety and soundness? Well, basically it means that you don't want the banks to go bankrupt. Okay, so prudential regulation is in the essence preventing bankruptcy. If we look at Minsky's definition is much more operational. Minsky's definition is what? Well, financial stability requires a guarantee that cash commitments can always be met. Okay? That's how you prevent insolvency. You make sure that cash inflows are sufficient to meet cash outflows. How do you do that? Well, there are a number of ways in which you do that, and when we get to the end of the presentation, we'll look at the kinds of proposals that I have. Now, if we look at prudential regulation and supervision, normally it tends historically to be conditioned by what banks in fact do. And I'm not going to go through all of these regulations, but if we look at the 1800s in the US, we had what was called wildcat banking. Wildcat banking basically said that banks could issue banknotes, and as Paul McCulley pointed out, banks generally, and Minsky always supported this, banks are basically speculative. That is, they issue commitments that they cannot honor. And what did we do? Well, we regulated the banks by saying banks have got to hold reserves. Okay, they had to hold gold reserves. So what would banks do? The supervisor would come into the Wildcat Bank, they'd pull out a big box full of gold. Supervisor would say, okay, good, this is a safe and sound bank. He would then get on his horse, go to the next bank, and the banker would then take the box and run as fast as he could to the next bank, and the supervisor would then see exactly the same box full of gold. Okay, that was prudential regulation and supervision for Wildcat banks, all right? And basically, this is the way the system runs, okay? You look at what the banks do, you set up some sort of regulation to make sure that they can meet these commitments that they cannot meet, and you set up the regulation that way. Now, basically what happened in the US is that we went through a series of these sets of regulations until we hit the 1999 Act and Dodd-Frank, okay? These things basically didn't provide regulations that were supposed to make the banks safe and sound. What they did was to say, let's let the banks do virtually anything they want to do. We'll put some Band-Aids on their activities, but make sure now that they have a sufficient amount of capital to avoid bankruptcy, to avoid insolvency. So it's a basic change in the way you look at the kind of prudential regulation. Now, what I would argue is that there's a better way to look at the way prudential regulation is operated, and that's to look at how banks make their money, okay? It's not what they do, it's how do they generate their income. So if we look at the range of activities, you find that what regulation has tended to do is attempted to change the way the banks make money, okay? In particular, Glass-Steagall did what? Glass-Steagall said, we don't want banks to make money by speculating in securities, so we're going to turn them into a different kind of money-making machine. And that money-making machine was in terms of providing what we call the monopoly on the payment system, regulation Q, 0 deposit rates. So basically you're giving the banks free money, they don't have to pay for it, and there are no capital requirements, as Jose noted this morning. Basically the US system functioned without any sorts of capital requirements until Paul Volcker got into the problem of trying to kill inflation in the 1980s. Capital requirements were totally unnecessary in terms of the safety and soundness of banking. What was required was generating a sufficient amount of income for the banks to be able to meet losses and to meet basic bad loans. Graham Leach Bliley, again, make money any way you can. And basically making money any way you can meant, number one, speculating, and number two, because the return on assets tends to be relatively low in the kind of competitive banking system. Remember, the monopoly was now eliminated for the banks. So competition, reduced returns on assets. How do you get the return on equity up? Leverage. Okay, so that by definition, these kinds of regulations said to the banks, okay, you go out and make as much money as you can. If you need to lever to do it, you do it. My favorite example of this is that Bankers Trust, which was one of the first banks that operated this, Charlie Sanders said, I'm going to take Bankers Trust and I'm going to produce a bank that gives you 20% return on equity. Okay, now, if you ever see a banker telling you that he's going to produce 20% return on equity when his return on assets is usually not higher than 1 or 2 or 3%, then you know there's a problem, and you know that he's got a whole lot of leverage. Okay? The point was that Graham Leach Bliley said, okay, that's fine. We really don't care how that works. Okay? Now, so if we look at Dodd-Frank, we said basically Dodd-Frank provided a system that was supposed to give you regulations. What did it do? It said that, okay, we're going to have your derivatives trades. Your derivatives trades are going to go on exchanges. Okay, as Jose said this morning, Secretary of the Treasury, what did he do? He didn't deregulate trading in Forex. He simply said Forex trades don't have to go onto a regulated exchange. But this didn't basically change the way the banks made their money. The only provision of Dodd-Frank is the provision that still is not implemented, and that's the Volcker Rule, which tries to cut back on the ability of banks to speculate on assets. So if we look at state of implementation of Dodd-Frank, again, I won't go through all of these, but basically, when Dodd-Frank was written, it was written as what we call a shell, and the shell had to be filled out. It is still not filled out. 40% of the 400 required rules haven't yet to be finalized. 60% of the deadlines have been missed. And if you read the financial press, every day you notice that one of the regulatory agencies that is responsible for implementing or writing these legislation announces that it's going to postpone implementation. Now, what this has done is to create, if you look down at the bottom, a certain amount of continued congressional dissatisfaction. So as I mentioned, we have a lot of proposals that effectively displace Dodd-Frank and attempt more or less to go back to something that looks very much like the approach that we had under Glass-Steagall. That is, to limit the way the banks make money and to limit the way the banks tend to operate. Now, there are a number of these proposals. Richard Fisher from the Dallas Fed is proposing a simple breakup of the large, too-big-to-fail banks. Tom Honig, who was the president of the Kansas City Fed and who has made a proposal similar to Fisher's, has come in with another proposal, now that he is vice chairman of the insurance entity, the FDIC, to restrict the federal safety net to banks undertaking core banking activities. Okay? So again, we're back to this idea that the regulation is supposed to be related somehow or other to what the banks do, and we're going to tell the banks what they can do in a very similar way to Glass-Steagall. The Brown-Vitter Act basically says the biggest problem we have is the Basel Committee. Let's get rid of the Basel Committee. In fact, it says we cannot have risk-weighted capital adequacy ratios. What we do is we're going to set gross leverage ratios, and that's going to be it. That's going to be the way we regulate. Finally, and not surprisingly, as I said, what is happening is the same thing that happened in U.S. history. That is, we started out with the crisis. We had Glass-Steagall. Now we have the Gramm-Leach-Bliley, which repealed Glass-Steagall. Lo and behold, the most recent proposal is Glass-Steagall all over again. Okay, so the 21st Century Glass-Steagall Act of 2013. Now, I won't go through all of these particular proposals because in general, as we've said, the basic ideas is that you're attempting to return banks to some sort of similar position to the one we had under Glass-Steagall. So if we just look at the Glass-Steagall Act, the return to Glass-Steagall, to reduce risks to the financial system by limiting banks' ability to engage in certain risky activities and limiting conflicts of interest, to reinstate certain Glass-Steagall protections that were repealed by the Gramm-Leach-Bliley Act. This act may be cited as the 21st Century Glass-Steagall Act of 2013. Now, basically, what does it do? It does exactly the same thing that Glass-Steagall did. Now, one of the interesting points is that 2, 3, I don't know, Dimitri, was it 3 years ago? I produced a piece which I said that it's impossible to go back to Glass-Steagall. And the paper goes through a series of reasons why it's impossible to do that. A number of them have to do with the way the courts treat legislation. A number of them have to do with the way regulatory agencies treat financial regulation. And a number of them deal with basically the definition of what is a bank. Okay, if you want, Glass-Steagall had one very clear hole in it, and it said that banks can do anything that is considered to be the business of banking. And when this part of the legislation went to the courts, it was very easy for banks to extend or to get rid of the separation that Glass-Steagall had produced. So all you had to do was to go to the court, and you tell to the court, look, I am a banker. My clients want derivatives. Glass-Steagall says that I can't trade derivatives. Rule. And the court would look, and the court would get representations from the financial industry, which would say, yes, the business of banking means providing the ability of your clients to hedge exposures so that you can do derivatives trading, or you can do securities trading, okay? So basically, what this particular law does is to say, we will define the business of banking. We're going to write it into the law. So if you look at the law, it goes through step by step. Each one of those factors that allowed for the repeal of Glass-Steagall is now written into this law. So that the idea is that if it ever goes to court, if the thing passes and it ever goes to court, we can say, no, it says here that you cannot trade derivatives. It says here that the business of banking is only taking deposits and lending short-term money, okay? So the problem with this is how will banks make money under the new Glass-Steagall Act? Because under the old act, what did banks do? Well, we said that they borrowed money at 0 interest, and they lent short-term basically to businesses. The problem is banks don't do that anymore. And in particular, Minsky noted in reviewing Glass that Glass-Steagall, when it was introduced, had this problem. That is, it presumed that banking business was different from what banks in fact did. So that at that stage it was outmoded. So basically, if you look at the difficulty with all these types of regulations, is that it's based on a misunderstanding, what I would call a misunderstanding of how the banking system works and how banks in fact make their money. So if we go back, once upon a time, bankers insisted that they simply accepted and kept the deposits of households. It was a story they used to have. If you were a little kid, you had a quarter, a 25-cent piece, you'd take it to the bank, you'd deposit it in your account, you'd go back 2 weeks later, and you'd ask the bank for your quarter back. And when the banker would give you a different quarter, you would say, well, this is not my money. This is not what I gave you. And obviously, because this is not what banks do. The problem was that when academics challenged this idea that banks don't create money, that is, that they don't simply keep deposits, okay, we came up with this idea that monetary creation came from the credit multiplier. That is, it came from the kinds of reserves that the banks kept. Remember our story about the wildcat banks keeping the box of gold, okay? So the presumption was that anything in the monetary system could be controlled by means of controlling bank reserves or by controlling high-powered money. And you have the entire monetarist tradition, which is based on this level. Now, for Minsky, what do banks do? Well, banks don't find reserves and then lend those reserves. What banks do is they go out and lend, and then they find the reserves. They find the reserves how? They find the reserves, as Jose said, you go on the liability side of the balance sheet, you get the assets, and then you fund those assets. Now, what does this mean? In particular, it means that, number one, banks always have what I called a speculative financing profile. Or, back to what Paul McCulley said yesterday, banks make commitments they can't keep. Or I would say banks are always short cash. Okay? They claim to provide you with your quarter, but they really don't have it. Okay? So, this means that if a bank can't meet its reserve requirement, which is supposed to be the prudential part of the operation, what happens? Well, central bank is faced with two possibilities. Either it allows the bank to fail, which it doesn't want to do, or it creates the reserves that the banks need. So implicitly, the reserves at this point become endogenous, okay? So that if we look at the stability under Minsky's definition, stability requires that the cash that you require to meet your commitments is always available, okay? Now, if it's always available, how do we do this? Well, we can go back to reserves, okay? In the beginning, we used to have reserves that we said were backed by physical things like gold. When we created the Federal Reserve System, the idea was what? The idea was that you were going to pool bank reserves, you would have a deposit in the Fed, so what you needed in order to meet that liquidity, to meet that short cash position, you simply went to the Fed and you took your reserves out of the Fed and you used them to pay off your short cash position. Okay? This was fine until, and I said until we came up with this idea that somehow or other reserves are controlling the money supply. And at that point, what happened? Well, you never were able to use reserves in order to meet your outstanding commitments. Why? Because reserves were supposed to control the money supply. Reserves were a money supply control mechanism. They were no longer a prudential regulatory item. Okay? Now, this morning, Jose talked about a whole series of measures to ensure liquidity. And I'm looking at all of these measures and I'm saying, well, really the only liquidity that we have in the system to meet your short cash position is to go to the central bank, is to go to the Federal Reserve. How did we used to do this? We kept a reserve deposit. What is a reserve deposit with the central bank? It's direct access, okay, to central bank cash. Now, if my reserve position is not large enough, the bank, the central bank, acts as lender of last resort. And it says, okay, if your reserve position, your potential reserve is not large enough, I'm going effectively to buy up some of your assets in exchange for cash. Okay? This is where the liquidity in the market is. No matter what kind of definitions you give of the kinds of assets that you think are liquid, they are only liquid if you can take them to the central bank and get the central bank to lend to you against them. So this business of Basel III of trying to calculate these liquidity conditions and to claim that this somehow or other makes the bank safer or sounder is totally irrelevant. If there is no market to sell the assets, the only market that exists is the central bank. Now, somebody mentioned that this is some new invention, that the central bank is a market maker. That's nonsense. The central bank has always done this since the creation of the Federal Reserve. That's what the Federal Reserve was there for, to pool those reserves. How much time have we got? 5? Okay. So this is the idea, is that if you're looking at the stability, stability comes from getting that cash. Now, the interesting thing is that High talked about a number of other conditions in addition to having reserves and having access to the discount window in order to be able to meet your commitments. The macro condition, government deficits. Government deficits do what? They support incomes. Supporting incomes supports cash inflow. So if stability is cash inflows meeting cash outflows, you want to act on the ability of borrowers to be able to meet those commitments. How do you do it? Well, big government, I called it. If the government is running a policy which keeps the economy running at someplace near capacity, then you're going to be generating incomes that allow the households to be able to meet those cash commitments. Okay? This is not a question of prudential regulation in the banking system. It's a question of prudential regulation for the entire system. So now we have this idea that prudential regulation extends, we call it macro prudential regulation. Big government is macro prudential regulation, and that big government means that the government is going to be running a deficit. Micro condition. Well, in the micro condition, I said that we want the discount window open to all financial institutions that are short cash. This is the big bank. And this is the point I mentioned before. People say, well, you know, now the bank is a market maker. High has always said that the only way that you can guarantee that you're going to have financial stability is if the central bank is willing to lend to all institutions that have balance sheets. You notice I didn't say financial institutions, all institutions, financial or non-financial, and against all assets of the system. Okay? So market maker or not, I mean, market maker is really nonsense. Market makers do what? Market makers are dealers. Market makers hold inventories of things. Central banks don't hold inventory. Well, now they do hold inventories of these assets because they had to buy a lot. But generally, central banks don't hold inventories of printing presses, for example. But they are willing and should be willing to lend against a printing press. So this idea of market makers is really a misinformation of the way banks work. Okay, then finally, at the end, I have what I call Minsky's secret weapon. Okay, Minsky's secret weapon is not really secret, but it's something that more or less everybody forgets. And that is, now let's go here, secret weapon. Number one, the basic idea, and this is something which came up already this morning when Jose was talking basically about the fact that High put emphasis on the idea that every position in an asset generates a liability. Okay? Now, if this is the case, and if you drive the system in terms of investment, investments are assets that require liabilities. So that if you drive the system, you drive the growth of the system by supporting investment, it means that you're going to be generating more financial liabilities and you're going to be creating more what I call financial layering, which is implicitly going to create risk. Is there an easier way to do that? And I says yes. If we substitute employment as the target rather than investment for economic policy, this is a precondition for financial reforms aimed at decreasing instability. The emphasis on investment in economic growth rather than on employment policy is a mistake. A full employment economy is bound to expand. Okay, think of that for a minute. Okay, we always worry about ramping up investment in order to get growth to expand. Sometimes it works, sometimes it doesn't. Okay? For the moment in Brazil, it's not working too great. On the other hand, if our objective is full employment, then by definition, the system is going to be growing because the Brazilian population is still growing. Okay? So this simply solves that problem. A full employment economy is bound to expand, whereas an economy that aims at accelerating growth through devices to induce capital-intensive private investment not only may not grow, but may be increasingly inequitable in its income distribution, inefficient in its choice of techniques, and unstable in its overall importance. So what do? Financial stability requires the stabilization of the income of the household sector. And I proposed what we call a government employment guarantee program that would ensure that households always had the income to be able to meet their financial commitments, that the financial stability of the system could be met. Remember, we said highest definition of financial stability is being able, and a guarantee that you will be able to meet those commitments. Well, this is another kind of what we would call macro-prudential regulation. And then finally, the idea of functional finance. That is that you use the government deficit to make sure that the system runs at full employment. Okay? You decide your budget position on whether or not you are or not at the level of full employment, rather than doing what? Running your budget balance in order to balance the budget. Because as Paul McCulley told us yesterday, this is probably not a good principle and certainly not very good practice.
I'm going to be summarizing the results so far of a project that we've undertaken.
Funding from the Ford Foundation. And so far, we have looked at three things. One is the causes of the global financial crisis. Second, what did the Fed do in response? And third, we've started to look at how to reform the way that the central bank responds to financial crises. But I became convinced that we can't really reform that until we reform the financial system in a way that it makes it possible to respond in a manner that is much more consistent with what we're trying to do, improving governance of the safety net in a financial crisis so that the Fed doesn't have to do what it did last time. And so there are linkages between Jan's project and our project because we're also concerned with improving the financial system itself. So I'll say a little bit about that. So first, the nature of the crisis. Of course, Paul came up with the Minsky moment that captures what we might think of as the trigger for the crisis, which came out of the came out of the U.S. real estate sector. And certainly Minsky deserves credit for his description of that process, which Jan had argued was Ponzi from the very beginning. But Minsky, in the later years, was developing, or actually returning to, a stages approach to the transformation of the financial system over a very long period. So in a way, the crisis was 50 years in the making. What happened was that we transitioned to a new form of capitalism that he called money manager capitalism, which is characterized by financialization, layering of debt on debt, and stretching liquidity. In addition, we had shredded a lot of the New Deal reforms, which not only constrained the financial sector, but also provided a safety net to income and employment and so on. We had been reducing all of those reforms. And then finally, we had this process that began under President Clinton, which included deregulation, but also the movement of the federal budget from deficit to surpluses, which increased the pressure on the private sector to go into deep deficits and issue lots of debt. So a lot of that overhang of debt actually began in the Clinton years before the real estate boom. And then finally we had this belief propagated by Bernanke that central bankers around the world were doing such a great job that we had essentially permanently reduced risk of the system, and we no longer needed to worry about that. This is what Minsky would have called, and he used this terminology a lot, a radical suspension of disbelief. That is, the recognition that your enthusiasm probably wasn't justified by the circumstances. Okay, so anyway, I could show you lots of pictures. I'll just show you one that sort of captures this idea of money manager capitalism, and why my argument is that it was a very long transition of the economy. You can see household debt growing on trend, and it does pick up a bit in the 90s. You can see corporate debt also increasing on a long-term trend. Okay, that's not really news to anyone. This is a long process. But take a look at private finance. So this is the layering, this is the debt on debt, this is financial institutions financing positions in assets by issuing liabilities to other financial institutions. That became 125% of GDP. On top of that, we also have the GSEs. Okay? So we have a massive growth of finance. And a lot of this is money under professional management, which is why Minsky called it money manager capitalism. So this picture does give you some indication that something was going on over a very long period of time that finally collapsed in the crisis. Now the question about the crisis is whether this was a liquidity problem or a solvency problem, because you ought to respond differently depending on whether it's purely a liquidity problem or it is a solvency crisis. We all know the recommendation that in a run to liquidity, the central bank has to lend without limit against good collateral at a penalty rate. Okay, so that's the long-standing recommendation of Bagehot. Banks had relied on extremely short-term finance, in fact, overnight commercial paper, in order to finance their position in assets. When we got some questions were raised about the quality of the assets they had been buying with this very short-term commercial paper, and so financial institutions that held the commercial paper refused to roll it over. Okay, so that created, obviously, a liquidity crisis. But it really was a problem of solvency. The assets were no good. Okay, so that is our view of the nature of the crisis. And so what we set out to do is look in detail at what the Fed did and try to determine whether what they did is more consistent with a liquidity crisis or a solvency crisis. The problem with the rule is what collateral should be offered, at what rate, and for how long should the central bank be involved in providing lender of last resort versus making markets. And I take what Jan said, but here we're talking about possibly a very long period over which the central bank was trying to restore these markets in assets that were highly questionable. Now, when the Fed intervened, it decided that there's a stigma problem if we force the financial institutions to come to the discount window. So what they did instead was created a whole bunch of special facilities in order to provide the funding, mostly through auctions. And so this was supposed to solve the stigma problem of identifying who's in trouble because they have to go to the window in order to borrow. The Fed also greatly expanded the kinds of collateral and who it would make the loans to. And you've all probably read about the Real Housewives of Wall Street. Basically, the Fed would lend to anybody if they would help to prop up a market. Okay, lending, it turns out, long-term at extremely low interest rates in order to protect these markets in questionable assets. And then finally, we move to QE as a sort of permanent stimulus. I'm not going to go into the argument of whether QE actually stimulates the economy or not, but the belief was that it could stimulate the economy. Okay, so if we look at the crisis response, first we had Hank Paulson of the Treasury going to Congress saying, give me $800 billion, don't ask me what I'm going to do with it, I'm not going to tell you anyway, right? And I guess it surprised him that Congress said no. Eventually they went back, he did get the money, and originally they were going to buy toxic assets. The problem with that was there was way too many of them, and so they switched to capital injections, okay? We got a little bit of fiscal stimulus, too little, too late, and it only lasted 2 years. So most of the response fell to the Fed. The Fed engaged in a truly unprecedented effort. At the peak, it was lending $1.7 trillion. Now, we went through the data on the loans, which the Fed originally refused to provide, but there was a lawsuit, a Freedom of Information Act lawsuit by Bloomberg, and also an effort in Congress to force the Fed to release the data. Finally, they did. They released 29,000 pages of data, completely unorganized, so it was very difficult to add it all up. So 2 of my graduate students added it up, and it turned out that there were $29 trillion in loan originations. When we first put this number out, we got attacked. They said, well, you can't just add up the loans. But at the last Levy conference, actually, the Fed, one of the Fed presidents, is using the same method that we used. Okay? So finally, it has become accepted that it actually is a useful measure of the effort. Okay? So this one gives you what was the maximum amount they had to lend at any point in time, which, if I remember right, is December 2008. But they had to continue lending for up to 4.5 years later. They're still making loans. Okay? Does that sound like a liquidity crisis? It sounds to me like a solvency problem. In the second phase, we started looking at what interest rates were they lending. It turns out extremely low. So I'll give you a little bit of data on both of those things. So what were they doing? Trying to prop up and restore, revive, reboot money manager capitalism. This picture, I think someone already showed this yesterday, something like this. We can see the Fed's effort. There's the red one. We see a similar, really unprecedented effort by other central banks, greatly expanding their balance sheets in order to deal with the crisis. Here is the Fed's balance sheet. You can see all of the colored stuff. This is all the special facilities. You can see that lasted through 2010, and then you can see QE after that, which includes a tremendous amount of mortgage-backed securities that the Fed has been purchasing. So this is the stock, right? This is the outstanding loans or asset purchases. Here is the cumulative. Here we left out a huge part of the Fed's effort, which was lending to central banks, largely the ECB. So that data is not included in here. It was included in the 29 trillion. If we exclude that, then take all the other facilities, 13 banks got 80% of all of those loans. Okay? And then we go into the details on at what interest rate did they get these loans. So just an example, I won't go through all of this. The top 3 cumulative borrowers borrowed close to 40% of all the funds, rates as low as 0.01%, as long as 4.5 years. As an example, JP Morgan borrowed 144 times, State Street 35 times, Citigroup 11 times, in one facility at 0.05%. So huge quantities of lending at extremely low interest rates. Here are some more. Another facility, $260 billion at 0.45%. In the single tranche open market, 0.01%, and Citigroup, Merrill Lynch, Morgan Stanley, $6 trillion at 1%. Citigroup, $2 trillion at 0.88%. So subsidized interest rates for a lot of this borrowing. And at one point, I actually was on the phone with Bernanke in a group phone call, and I asked him, you know, is lending for periods up to 2 years consistent with a liquidity crisis? And he said, oh, we never lent for 2 years. They lent for 4 years. Okay, we have the data to show it at very low interest rates. All right, did we learn any lessons? Well, I don't think central banks should be providing unlimited official liquidity support to a financial system that had been growing much too fast. Now, I do think that their lender of last resort without limit for a very short period is absolutely essential. Probably needs to be done behind closed doors, okay, in secret, and you could justify that for several weeks. Beyond that, it should be out in the open what they are doing. And I don't think that what they did last time should have been permitted. We'll need stronger regulations to limit the private liquidity growth or the layering or leveraging, and we need to rethink what banking is all about. So we've gone back to Minsky, and Jan already said this, that banks create money by lending their own IOUs. Okay, and there's no inherent limit on this. The limit should be that they've got credit-worthy borrowers. Banks are not primarily intermediaries. They don't move savings around. Private liquidity is highly endogenously created. It grows in booms and disappears in busts, which is what Paul was saying yesterday, the difference between the ex ante and the ex post. Bank credit can be highly destabilizing, and that's the core of the instability hypothesis. When Minsky came to the Levy Institute, he started a new project, which actually is the foundation for the annual Minsky conference. He called it Reconstituting the Financial System. And note the purpose, to promote the capital development of the economy. So his argument was where the financial system had gone by 1990, over this long-term transformation from the post-war period, it was no longer financing the capital development of the economy. What he wanted to do was to reconstitute it so that it would finance capital development. Now, by capital development, Minsky didn't just mean private plant and equipment. He had a very broad definition of this. It included human capital, so it included education, okay? He argued that in order to do that, we need a framework, which of course is a Minskyan framework. A capitalist economy is a financial system. Neoclassical economics isn't useful because it denies that finance matters. So we've got the efficient markets hypothesis, Modigliani, Miller before that. The financial structure has become much more fragile, and the fragility makes it likely that it could happen again. If you remember his 1982 book, he argued that it can't happen again because we have the big bank and we have the big government. But by 1991, he's arguing it can happen again, okay? A stagnant capitalist economy will not promote capital development. However, this can be avoided by apt reform of the financial structure. So he wrote a series of papers in which he was trying to do exactly this, apt reform of the financial system. So that's what we're looking back to see how could we reconstitute it, not only to make it more stable, but to make it possible to regulate it and to react to a financial crisis in a much more palatable way than what we had to do last time. This room has always been so cold, and now it's what, tropical. People would probably take freezing right now, I think. Okay. Anyway, so what should the financial system do? So when you go through his writings, you can identify 5 key components of a financial system. So first, you need a safe and sound payment system. Okay. Second, short-term loans to households and firms and possibly to state and local governments. You don't need the financial system to provide finance to the sovereign federal government, but state and local governments might need that. Third, a safe and sound housing finance system, which of course we had in the US until 1974. And then we freed the thrifts and very soon had our first really serious financial crisis in the US in the 1980s after we had freed them. And of course then we completely destroyed our safe and sound housing finance system when we moved to the mortgage-backed securities and all of that stuff in the 2000s. A range of financial services, including insurance, brokerage, retirement savings, and finally, long-term funding of positions in expensive capital assets, which used to be the job of investment banks. He emphasized there's no reason why these need to be consolidated in one big box financial institution. He argued that there's no reason why these need to be privately supplied. There's a role for the government to play, maybe in every one of these, okay? So we need to do an evaluation of whether it makes more sense for the government to provide the service or for the private sector to provide it. Reforming finance, what sort of a path might we pursue? We need to reduce concentration and get banks to retain the risk. A big part of the problem obviously was that the banks did not retain the risk. They pushed it off onto pension funds and money market mutual funds and so on. A role for the government to play in re-regulating and re-supervising the financial system. The belief that the financial system could self-supervise, again, was exposed in the crisis. There are no magic formulas. Minsky actually went through the argument that raising capital ratios will make banks safe and argued that actually it might make them much more risky. Higher capital ratios make it harder for them to return a profit. And Minsky was always concerned with making sure every piece of that financial system, all of those 5 functions, they have to be profitable. Every piece has to be profitable. And raising capital ratios can just make them less profitable so that they have to take on greater risk. There's a role for the government in direct provision of financial services. Just as an example, it may make sense to return the payment system to the government sector. We used to have a postal savings bank system in the US, and that could make sense, and that deals with the problem that Jan was talking about. Maybe it's too difficult to make the payment system profitable. In that case, it makes sense to move it out of the private sector. Direct lending to serve the public purpose, and guarantees for public-private partnerships. I also like what Paul said yesterday. There's no such thing as a private bank. They're all PPP. They're all private-public partnerships. We need to reform the policy response. As I said, it makes sense when you're in a run on a bank to provide the liquidity initially in secret. But so much of the policy response undertaken by the Fed and also with the Treasury when financial institutions were in serious trouble was done behind closed doors in what's been characterized as deal making in secret. Even after the fact, the Fed and Treasury refused to provide the information to Congress. Okay? This is not acceptable in a democracy. When our automobile companies got in trouble, Treasury responded. They went to Congress. Congress debated a while about whether the U.S. auto industry was worth saving. They decided in the end that it was. Okay? It was all done in public. There's no reason why we could not have had a similar debate about money market mutual funds. Are they really worth saving? Let's have a public debate. Okay? That wasn't done. We need to simplify I do like segmenting the financial system. We've got those 5 functions. There's no reason why all 5 functions need to be done in one large, highly concentrated financial institution. We may want to have a global leverage ratio for these big institutions. We may want to divorce the payment system from the banking system, or we may want to force banks to fund their positions with deposits as they used to do, so that we don't have to worry so much about this extremely short-term, very volatile overnight funding that banks are using. Limit the central bank's market maker role, but here I'm not talking about in a liquidity crisis. I'm talking about trying to reboot markets that the market itself doesn't want. The market is voting against it, and the Fed is trying to recreate it. Tougher collateral rules and stop the too big to fail policy. Now, in principle, we already have. And so we have people from the Treasury or OCC saying, oh, yeah, we've eliminated too big to fail policy. But nobody believes that. Okay? No one believes that they're going to allow the biggest institutions. So we need to get a policy that actually is going to be enforced. And we need resolutions for those big institutions when they get into trouble, rather than bailouts to keep them in business. Okay, thank you.
There you go. And the idea is to try to take Minsky and to develop a financial fragility index. So what's the rationale? Well, over the past few years, okay, you have had a growing concern about the risk of debt deflation and macroprudential risk, as it's called. And so in the United States, that was institutionalized through the Financial Stability Oversight Council, but other countries also have similar preoccupations. And so the goal is to try to contribute to that debate using Minsky. And so what I'll do is go through the theoretical framework that justifies using Minsky, develop the method, and show you the index and what you can do with it. And I will specifically use the index here to measure financial fragility in housing finance and see how it works and how it helps to understand what happened recently. So if you look at Minsky, some broad quotes first to try to give you a context, where he says that robustness or fragility of the financial system depends on the size and strength of the margins of safety and the likelihood that initial disturbances are amplified. So what we're looking at is trying to find a way to capture the amplification process that results from a disturbance. And the second quote is the overall fragility or robustness of the financial structure upon which the cyclical stability of the economy depends emerges out of the loans made by bankers. An emphasis by a banker on the collateral value and the expected value of assets is conducive to the emergence of a fragile financial structure. One measure of the riskiness of the financial instrument is the expected source of funds that are needed to fulfill financial contracts. And so I'm going to take these two quotes at heart and try to see how you can use them to basically develop the index. So let's try to first go a bit more in detail about in terms of their meaning. So what we're trying to do with financial fragility is measure the risk of debt deflation. And so we are looking at trying to measure the amplification process. Okay, and so we're not too much interested in here measuring credit risk or interest rate risk, but we're more interested in figuring out, say those things happen, will that amplify or will that be contained? Okay, or if you want to put it in another way, will that generate a debt deflation? And so in that case, one of the things you want to look at, and that Minsky emphasized, is the underwriting methods. Okay, And so if you rely a lot on what you call position-making operations and on collateral-based lending, okay, the risk of amplification is very high, okay, from this disturbance, because you create a very high interdependence between asset price and debt, okay, and this relationship between asset price and debt on the upside that is important. So you want to look at the debt inflation process, because without the debt inflation process, you cannot have a debt deflation process. Okay, so you want to look at how they both interact and feed on each other, basically. And so the goal of the index is then to measure financial fragility in a way that is not based on credit risk or interest rate risk. And so what you want to be able to capture is a growth of financial fragility when default rates are low, when you have low foreclosure rates, when profitability is high, net worth is rising, okay? But you will have rising financial fragility because the profitability of banks, the growing net worth of households is based on an unsustainable process that is based on collateral-based lending and the reliance or the expected reliance on position-making operations. That is on refinancing and asset liquidation to service debts. So, to go more into the nitty-gritty, and I think most of you know this, but I will go a bit more in detail to show you how that applies to the index. Okay, so to measure more carefully financial fragility, Minsky developed this category of hedge, speculative, and Ponzi. So the hedge finance, okay, there is an expectation at the beginning of the loan contract that the debt will always be able to be served with the routine cash flows of an economic unit. So labor for workers, okay, a going concern for companies, okay. And so even if there is, in addition to that, even if there is an unexpected deficiency in terms of routine cash flows, there are enough buffers in terms of liquid savings to be able to make for the servicing of debt. So you really don't have, the consequence of that is that you don't have to rely on what Minsky called defensive position-making operations, so you don't have to borrow to be able to service your debts, and you don't have to sell illiquid assets to be able to service your debts. Okay, and so formula at the bottom here is saying that the expected net cash flow from position-making operations is 0, okay, because there is no change. Where's the laser is this? There is this is the amount of refinancing, the amount of asset liquidation, okay, is 0. At least expected to be 0. Speculative finance, as you know, this one, I guess you know all that, is you are expected to be able to service your interest, but not the principal component, at least in part. And the consequence, and in addition, you don't have enough cash, liquid savings. So the consequence is you're going to have position-making operations. You're going to have to ask for refinancing or sell assets to be able to service the principal. Okay, the point of speculative finance is that the size of these operations, position-making operation, is not growing relative to the amount of debt that you have. Okay, it will tend to be stable or decline over time. Okay. Ponzi finance, well, in that case, you are not able to even service the interest, okay, at least for a period of time n. Okay, and there are two types of Ponzi finance categories. One is where n is lower than the maturity of the loan contract. The idea here is, as Minsky put forward, is that you have investment goods that are expensive, and so for a period of time until those investment goods are installed and can generate profit, you're going to be in a Ponzi position, but afterward you'll be able to make a profit and sell goods at a price high enough to service your debt. And so ultimately, this loan structure will work out because you have an income that will be generated by your assets that will be high enough to service your debt. Now there is another category of Ponzi finance which is collateral based, where in this case n tends toward infinity. That means there is no expectation whatsoever that you will ever be able to generate an income high enough from the holding of your asset to be able to service your debt. So that means that you're going to have to sell your asset at a high enough price to be able to make this operation profitable. Okay. And so basically here you have a high interdependency between leverage and asset price appreciation. And so that's the core of Minsky. Okay? And the idea is that you have growing and growing needs to use refinancing and asset price liquidation to service your debt. And of course, the point of Minsky is that of the financial instability hypothesis is that over time, the proportion of Ponzi finance grows. And so with the growth of Ponzi finance, financial fragility grows, and that means the risk of a debt deflation also grows. Okay. The point here being that the goal of the Ponzi finance is to really try to capture the growth of this debt inflation, this growing interdependence between asset prices and debt. Okay, so let's go a bit more in detail into the categories to make sure we're on the same page. So first of all these categories, if you leave aside fraud, okay, and you suppose that all bankers are honest, okay, I'm not too sure you can make that supposition, but let's assume that. Okay, in that case, all these have to have a positive net worth, okay, before they are implemented, because a banker won't lend to you if there is no positive net worth in the loan contract. You can add fraud, okay, and fraud here usually fraud is associated with Ponzi finance. You never know. Fraud can occur at all stages of all categories, even hedge finance. Okay, and so you can have liar loans, okay, where you declare an income that is much higher than what you earn. Okay, and so during the underwriting, okay, you might have hedge financing, but it's actually not the case. And so we're not also trying to measure the existence of a bubble. Okay, so in the formula where I show you the need for position-making operation, I didn't try to figure out if the price of assets was correct or not, or was above fundamentals, however you want to define. Okay, I'm not trying to measure that. What I'm trying to get to is the interlinkage between asset prices and debt. And that's what you're trying to get to. The idea is, again, that you may have a bubble, okay, but if there is no debt sustaining the bubble, you cannot have a debt deflation because you're missing the debt component. So you have to have a debt deflation, you have to have asset price appreciation, okay, unsustainable or not, bubble or not, we're not really concerned about that. We're more concerned about what are the means used to service your debt, okay? And the expected means to service your debt. And so what is the main difference between the three categories is the expected reliance on position-making operations, okay, where hedge finance does not rely on any, and Ponzi finance relies on growing position-making operations. And also the underwriting is completely different. In hedge finance, you rely on income as a source of servicing debt. And in Ponzi finance, at least one category, you rely on asset liquidation to be able to service your debts. Okay, and so as you move toward Ponzi finance, what you should observe, okay, and we're trying to move toward more the empirical implementation here, debt burden rising, so the debt service ratio will rise. You will have growing needs to to use defensive refinancing needs, or asset-based lending will rise. Asset price will rise, at least if you look at the loan position. And for housing, that's the case. And the amount of liquid assets related to liabilities should also decline. And so the goal is to try to say that all this should happen simultaneously if you have a growing financial fragility. So before I go into the nitty-gritty of the index, just a few pictures for you here for the US. So here it shows you the share of exotic mortgages in non-prime lending. So the gray one is interest-only mortgages, okay, where you only pay the interest for a period of time and then the principal kicked in. And of course, because you didn't pay the principal for a long period of time, the principal payment is much higher for the rest of the mortgage payments when it occurs. And then you have payment options mortgage, where there the idea is you have three options, where you pay the full debt service, you pay only the interest, or you pay only part of the interest. Okay, and of course, if you only pay part of the interest, what happens is what the interest component you didn't pay is added to your debt. So your mortgage debt grows over time. Okay. Here, the amount of low doc, no doc mortgages, again, to try to show you that fraud is really not something that is only something subprime or Ponzi. Okay. The share of low doc or no doc mortgages grew for all mortgage categories, and it grew the fastest in proportion for prime lenders, from prime borrowers. Okay, so in 2006, okay, almost 50% of prime mortgages originated that year were of low doc type. Others already had, especially Alt A, that's a whole story. They had low or no doubt, very frequently before. Okay, also, last picture here shows you the serious delinquency on mortgages, okay? And you can see that from the 2003, you have a decline in delinquency rates, okay, up until about 2007, okay. And so, if you want to try to capture fragility using default rates, which is one measure that some people use, the main issue here is that you can only measure financial fragility this way, really just when the crisis occurs. Okay, so you miss out on all what happened before, okay, when default rates were declining. And I'll show you that actually financial fragility was growing at that time. So what are the variables that are used? So I'm going to try to do this for 3 countries. Okay. And so the first one is the US, where the most data are available. UK, where there is some data. Okay. France, there is even less data. Okay. I wanted to do it for Spain. A lot of people ask me, why didn't you do it for Spain? So Spain has 0 data. And then GDP, like it doesn't go like 2000. Before that, you have nothing basically. So very poor amount of data. So I cannot do Spain. So I did a home mortgage for households related to GDP. That home price index, mortgage financial obligation ratio when available, which is only the US. If I don't have that, I take the interest obligation ratio. Of course, that misses the principal servicing. The proportion of home equity loan in all mortgages. So the idea is to try to capture collateral-based lending. If I don't have that, I take the cumulative value of home equity withdrawals. So there are limits to do that, but that's available to be in the UK. The proportion of what we call cash out refinancing mortgages, okay, among all mortgages, okay, and finally the ratio of mortgage debt to monetary assets. And so all debts are seasonally adjusted, okay, and they are measured relative to 1996. Why 1996? Because it's a period of stability, okay, in the housing market. And then, so all the variables are weighted. Okay, so how did I choose the weight? I used 3 methods. All of them are more or less arbitrary. The statistical method, which is the principal component analysis that I used here. The equal weight, and one based on theory. Okay, what I think the most important variables are. Okay, and the idea is to try to see how is the index affected by different weight structure. And you'll see that the conclusion is that not much. If you have, the better data you have, the less significant the weight structure is. And so that will be the case for the US and then UK and then France. Okay, so here is the index. Okay, so I put for the 3 countries, and in each country you have the 3 weight structure. So for the US, you can see that it doesn't make much of a difference. Okay, you have growing financial fragility. Okay, and especially high from 2003, and then declining after in 2000, about 2008, 2009. And France, you find similar trends in terms of the index, but much higher financial fragility when you use the principal component analysis compared to the other 2. And UK is in between France and the US, okay, where again they are not as close as the United States, but closer than France in terms of overall trend and overall level. Okay, so these index can only be used within a country. Okay, you cannot compare across countries with this index because for that you need to compare, say for example you have the amount of liquid saving relative to debt in France, okay, maybe much higher than compared to the US. And in that case, it means in France you have a much lower financial fragility given everything else. Okay, and so these indexes that I should just show you don't do that, they don't compare across. If you want to do that, you can. Okay, there are index techniques that allow you to do that. The problem is that you're going to lose a bunch of information because a lot of data that is available in the US is not available in France, for example. And to create such cross-country index, you need homogeneous data. Okay, and so some data that are available in the US are not available in France. Okay. And so if you try to do it, okay, you can. What you find is this. So here you can compare across countries, okay. And so all of them shows rising financial fragility, but much higher in the US, okay, and the UK came close to the US. France is much lower. One reason France is much lower is that some of the lending practices that were authorized in the US and the UK were not authorized in France until much the end of the boom, 2006. Home equity lending, okay, was not allowed in France until 2006. And so all the collateral-based lending has a much lower chance of occurring in France. Another extension you can do, okay, you can make with the index is do something like what the IMF does, which is a heat map. And what you do is look at standard deviation relative to an average. Okay, so if you do that, okay, what you see is that for the US, okay, the index was starting to grow. I'll show you. Was starting to grow very fast from 2003. Okay, and by early 2004 or mid 2004, you start to have a value of the index that is going high, much higher than its average. Okay, and so by 2005, mid-2005, you have a very high financial fragility in the United States. Okay, that continues again until 2007, 2008, and then goes down again. UK also has financial fragility growing from 2005, okay, and then declining. And France, again, that has the least reliable data, okay, has growing financial fragility around 2000, much later than the other ones, and still much higher than the other one now. Okay, thank you.
Thank you very, very much. We have some time, considerable time actually, for your last questions. Yes.
This is not a question, it's just a comment. So I'm talking about. This is a subset of them, but it's been my experience in many of these countries that the Ponzi finance process must be conceived more broadly, and it is absolutely essential to how these financial excesses and crises occur. In the case of Latin America, I was on I was a policymaker in the Horn of Latin America, and the Ponzi finance process, without collateralization, was the driving element. And in the third world debt crisis, at the end of the 1970s and beginning 1980s, once again, we did have Ponzi finance between sovereign lenders and sovereign borrowers for a period, and it was not collateral based. So what is it based on? And this takes us back to behavior, adaptive behavior, and uncertainty. And usually what happens is that we don't know what the cash flows will be, and we live in an uncertain and highly cyclical world. And so collectively, the lenders and all the borrowers make big mistakes. And they think that the cash flows will come back, and they don't. And so they get engaged in a Ponzi process that creates financial instability, and it all exists in this uncertainty. And it was really Keynes who understood this best in the relevant chapters in the general theory. So I just wanted to make that comment. This is valid, but the Ponzi process is absolutely important, and it's much broader and much more profound. Thank you.
We see here economists from United States fundamentally discussing how to change governance of banks, how to regulate finance. While at least was my position, and this position of is because finance is a fundamental requirement for capitalism to work. So domestic finance, you have to have it well regulated. But what I discussed yesterday, what I'm defending, is that international finance is not required for developing countries. That developing countries should not normally recur to foreign finance, because this foreign finance involves not only getting indebted in a foreign money is one thing, but second, because this involves a current account deficit when a country like that has the Dutch disease should have a current account surplus. I'd like to have the comments of the two about this. What is difference?
A couple questions. One for Éric. I noticed that for all three countries, the fragility index by 2010 or 2011, I couldn't tell exactly when your last data point was higher than it was in 2004. So that would mean that now, if it hasn't changed dramatically, we have a higher fragility in each of those countries than right before the crisis sort of expanded. So I wondered if you could comment on that. And I wanted to ask Randy, in your big diagram of the growth of credit and the expansion of the inter-financial system component of it. It seemed to me that the economy needed that liquidity to some degree to function smoothly, but it was coming from an unstable source. So does the Minsky program for reform provide for the rapid growth of liquidity necessary for the sort of liquid functioning of a fast-growing economy that's properly capitalizing its long-term asset needs? That's my two questions. Thank you.
And you are very interesting your indicators of fragility. But I will ask a question. If you were the central bank and you were following these indicators, when have you intervened? What would you have done?
So, so quickly on the first, the income and capital, the role of collateral in Ponzi finance. But you can have indeed a disappointment in terms of expectation that put you in Ponzi finance. And so, again, the idea here is that if it's income-based, okay, you're going to have a lower chance, or the debt deflation will be much less stronger than if it's collateral-based. So Ponzi finance has those two components. Okay, so the more you rely on collateral to be able to service your debt, the more the chance of debt deflation is high. Okay, but you can have income-based Ponzi finance that will create some instability, but much less than if you're a collateral-based lending. Regarding the index, in terms of comparing 2004 to 2010, the idea here is that, well, all the variables, say for example the debt service ratio, okay, was still very high, okay, and so compared to 2004, and so that would make the index much higher and much more fragile, okay, and so that's one of the reasons. At the same time, what I like to rely more than just the level of index is the trend. I think that's one of the things that I really like to emphasize a lot. And you have declining financial fragility. Why? Well, because we are in the debt deflation period, okay, and by that time things are broken apart, and so the fragility is declining. Okay, you are simplifying the process. What would I have done if I was gone? Okay, when? Well, if I was Greenspan, I would have listened to Graham Lynch, probably from 2001 already, more carefully. Sheila Bair also was pretty adamant that we had to do something, so I would have listened to them more carefully from 2001. And if you look through the FOMC report, actually, there were discussions of these issues already, and from 1999, some people were saying, well, there's something going on here that is not too clean. But, well, I would have listened to them more carefully. And in terms of implementing, again, if you look at even the staff of the Federal Reserve in 2005 proposed to ban mortgage lending based on purely looking at collateral. So you had to look at income. Don't grant ninja loans. Okay, no income, no asset loans. Okay, and that was proposed by the staff, but again rejected by, well, Greenspan. And so, yeah, you could have forbidden those practices very early. Yeah.
Okay, I'll start out in response to Frank and Professor Bresser. I disagree with Éric about this idea of honest bankers. I really have never found any. Basically because of his condition that you need positive net present value for all three of the schemes. Bankers always lend against negative net present value schemes. They do it for all sorts of reasons, but they do. And in particular, this is one of the reasons that you do get a Ponzi financing, is that bankers are willing to lend to negative net present value because they believe that eventually things are going to turn up, or they will be able to liquidate the position. Now, this then gets to Professor Bresser's position, if you look at most emerging markets or developing countries in general, international bankers are even less honest than Éric's domestic bankers, because they are virtually always willing to lend against negative net present value positions, simply because, and this goes back to the old head of Citibank's adage, that sovereigns will always be able to roll over their debts. So that if you can always roll over, by definition, okay, you can build up a very substantial Ponzi finance position. Now, for most developing countries, what we tell these countries is that they should expand, or they should develop, by importing capital equipment, and they pay for this by setting up what in general is a deficit on their current account. So by definition, what we're doing is we're telling the financial system to lend to these countries at zero or negative net present value on the probable belief that they will not be able to pay back. And in general, they have not been able to pay back, and this is what is producing financial crises that we've had. So the basis of Professor Bresser's position, and the position I think I hold as well, is that both for international bankers and for developing countries, it is probably not a good idea to engage in what we call a debt-financed development strategy. Now, what particular strategy we use? Yesterday we had a discussion about export relative to domestic demand-led development, but basically what this does is to say that in general, developing countries and international bankers will be engaging in Ponzi finance schemes. Now, beyond this, I won't go any further than to refer you to a paper by M.C. Domar, in which he sets out the conditions for which it is stable for a developing country to run a current account deficit development strategy. And basically that condition is that the interest rate that it pays on the money that it borrows should be lower than the rate at which it expands its borrowing. Now, the interesting point about this is I think my one claim to fame in development strategies, is that if you think about that condition, you know that this is the formal condition for a Ponzi scheme. That is effectively that you're always able to borrow in order to pay off the debt service that you're incurring. So that by definition, the stability condition
gets in trouble, as Ireland did, because of bank lending in foreign currency. So that is a huge problem, I agree with you. Whether private firms ought to be allowed to do it, that's a different matter, because you can let them go bankrupt if they get in trouble. On the growth of the debt, do you need growth of debt? Well, you need some growth of debt, and we saw that the household sector debt was growing, especially after '96. It was growing too fast. Okay, the question about when, you could tell by 1999 or 2000, and Dean Baker was already warning about the real estate bubble by then, and I wrote a paper in 2000 on the coming real estate bust in 2000. So it was obvious. So there was actually too much private sector debt, and that is related to, if I can show you the picture again, government debt was not growing fast enough. So that's the problem. Our budget deficits were far too small, and of course we had a budget surplus under Clinton for 2.5 years. That is why the private sector had to grow its debt ratio, because it was running large deficits, 6% of income, because the deficit was too small given our current account balance. So it comes back to the WNGA, the three sectors. The U.S. runs a current account deficit, and for our private sector not to run a deficit, we need a big budget deficit to offset that and to allow the private sector to save. And of course, by 1996, the private sector was running deficits and did so for 10 years. Now, in the picture though, you don't need financialization. Financialization is not finance, okay? They're completely different. You can provide finance with no financialization. We actually built and financed the purchases of more houses in 1974 than we did at the peak of the real estate bubble in 2006. More, all through thrifts.
How do they finance it? By issuing savings deposits. That's not financialization, that is finance. Okay? So that explosion of the financial sector's indebtedness is a recent phenomenon. You don't need that at all to provide finance.
Yeah, I don't know. If I can just come in on this, I think this is an extremely important point because people tend to argue that it was household consumer borrowing that caused the crisis. U.S. consumers have always borrowed. Now, how in the world did we create the mass consumption society in the United States if consumers were not borrowing? Okay? They always were. As Randy's point is the borrowing that took place. It's not the consumer borrowing that was important. It was the borrowing across financial institutions.
For Jan and one for Randy. For Jan, you went through all the propositions, the new proposals for financial reform, and then you landed on Minsky, right? And to me, it was interesting that when you landed on Minsky, it was not so much about, specifically about financial regulation. It was, you had the big bank, the big government, and the employer of last resort. So my question then begins here by asking you that, well, would it be the case that in a properly reformed financial system, there would not be a great need of much regulation from the perspective of Minsky? But then let me just focus on one aspect, which is financial innovation, because this is something that Minsky always referred to, right? A banker is always under pressure to innovate. And so financial innovation is at the very center of his whole thinking about it. So again, I think I come back to my question to the previous panel. So if you accept that financial innovation is and will be at the center stage of the evolution of the financial system, then how would Minsky think about dealing with that? And then that gets me to a question to Randy, which laid out a sort of a comprehensive proposal for reforming the financial system, which is also a very radical one. So in that case, I get back to my initial remarks to the conference, which is about what are the politics that should be in place in order to get that kind of reform done. Well, and I ask it by underlining the fact that how do we get this done under this ambiance, if you will, that we have right now of governance by lobbying, which is very much imperative of anything that resembles what you proposed. Okay, thanks.
Yes. Let's take it.
Probably it's me, but I couldn't quite understand your indexes. My question regards, so if you have an index number, I don't get why, for instance, in the case of France, you have no intersection between the index, because if you have an index number, what an index number tells you is relative comparisons, but not levels. And I think this links to Roberto's question. When this quantitative measurement should indicate that at some point there is a financial risk, and so which level reveals that, if that's correct?
Following Craig's presentation in terms of the need to come up with financial fragility indicators, not necessarily an index, that's going to be a different story, but in terms of even financial reform and global finance, to use a Minsky framework at the national level becomes extremely difficult because, for example, for several countries, as you mentioned, you cannot just find even the data, right? So as a starting point, for policymakers, it is extremely important to try to collect the kind of information. The Brazilian government is moving towards that direction to collect that. So that's one thing that I'd like to hear comments on that. Second, about the index, how do you take into account financial innovation? Because, you know, that's going to be a dynamic change. So for the index, that might become a problem because one, you might have different financial innovations in different places. And in the US in particular, for the past, before the bubble burst, for the previous 5 years, there are a lot of innovations, as you know quite well. So how can you make your index dynamic in that sense to capture that financial innovation that you have, especially, you know, when you have created financial markets? And I think they have done a great deal of work because what it did to go to different sources to collect the data. I think that's a big challenge as well.
When I set up this session, we set it up with 15 extra minutes, but apparently the timekeeper didn't notice this. So my presentation was programmed for half an hour, and in order to keep to the time, I had to skip the detailed presentation of Minsky's proposal. So, as I say, thank you very much for asking the question, which is going to give me the time to actually do it. Now, basically, the context of this within the other proposals is all of these things have to do with, number one, too big to fail, and number two, the fact that deposit insurance creates the moral hazard, which generates too big to fail. So all of these specific proposals that we looked at somehow or other attempt to solve that particular problem. Now, the interesting thing about Minsky's proposal is that what he does is to say, let's get rid of deposit insurance altogether. And if we do that, then we're going to solve the problem. Now, how did he propose to do that? He said, well, you can set up a bank holding company system in which the specific subsidiaries carry out the different functions. This is one of the things Randy mentioned, that you can have segmentation. You don't have to have everything under one box. In particular, I talked about setting up a subsidiary that took care of the payment system or the transaction system. And he said this should be technically what we now call a narrow bank. Okay? Now, if you do that, you no longer need deposit insurance because the bank cannot fail. It is a hedge unit rather than a speculative unit. Okay? Now, the difficulty with this, if you think about the concept of a hedge unit, it means that the banks can no longer create liquidity. That is, they can no longer engage in the kinds of Schumpeterian financing, the creation of liquidity that is required to allow the system to grow. So the question is, where does this other stuff take place? Well, it takes place in the other subsidiaries that are going to be financing capital development of the system, and you can have specific subs, a merchant bank, an insurance sub, you can have a whole series of these specific functions. And then Hai says, but there's always going to be this fact that we want these subsidiaries to be lending and to be making losses. Okay? Now, if they're lending to finance productive activity, and we want to encourage that activity, then why don't we shift the insurance function to the subsidiaries that are financing productive investment, rather than having the insurance function insuring the payment system? Let's have a payment system which is stable because its assets and liabilities are fixed in terms of price, but allow those other subsidiaries. So he proposes having a government insurance fund for a certain share, and this is back to this public-private business, for a certain share of the investments that the banks are making in those productive activities. Now, this is the way he solves, number one, the problem of moral hazard. He takes the moral hazard away from the deposit function. Number two, if you're splitting up the banks into these specific subs, then by definition they're going to be much smaller than they were before. And if they're smaller, then it is possible to regulate them. And the idea would be that the sub, which is getting the insurance, would be regulated, and it's now going to be regulated not in terms of the funding side, it's going to be regulated in terms of the asset side. That is, the regulators are going to be looking very carefully at what we used to call not quantitative, but qualitative control. Okay? We don't want qualitative control, we don't want quantitative control. We don't want to fix the amount of assets in the system, the amount of liabilities that get created. We want to regulate the kinds of investments So you're back to a sort of directed financial system that you found, for example, in post-war France and in most of the European countries before we hit deregulation. Okay, it used to be absolutely normal that you had central banks or governments exercising qualitative control over bank lending. And there's absolutely no reason why we can't go back to that now that we have understood that self-regulation does not work, market regulation does not work in terms of selecting the kinds of investments that actually produce growth and employment. So thank you very much for asking the question, and this gives the possibility of putting forward what was, again, Minsky always had this very innovative way of looking at things. And everybody, all of those other proposals say, okay, let's not get rid of deposit insurance, let's just make sure that nobody ever has to use it. So I said, no, let's just get rid of it altogether. We don't need it. And let's put it where we want it. That is, we want to encourage risk-taking, we want to encourage investment in productive activities, so let's give a subsidy to those sectors by putting the insurance there.
Randy?
Okay, I wanted to say something about innovation because obviously that played a huge role in Minsky's views. So innovations usually stretch liquidity and increase fragility. And if you look at the past 30 years or so, what were innovations for? They were to get around rules and regulations, and they were to create synergies to screw their customers. Those were the two main reasons why we got financial innovation. Paul Volcker was asked, can you think of any beneficial innovations since 1979? He said, one, ATM machines. That's it. That's all there is. Okay? So I like, Éric has promoted this idea that innovations, they should go through an FDA process. If you can't find a benefit for them, they're not allowed. I also like the idea that some countries say, unless it's explicitly legal, it is illegal. And that's the way we ought to treat at least the regulated part of our financial system. Okay, you're not going to like my answer on the politics because it's not going to be any more satisfying than what you got yesterday. I think it's just extremely bleak. The prospect for real reform is bleak because of the money in politics. So what are we trying to do? We're trying to say, okay, here is what the Fed and Treasury did. And when people find out, they're horrified and disgusted, okay? So I think that first, you get it up, this is what they did. We can't allow this to happen again. And given the financial system and what we did to prop it up and say, oh, go back to doing what you were doing before. And then we've got, like Kevin said, these people saying, oh, it all worked. It worked perfectly fine, we're going to crash again. So that's, in a way, the good news. We will crash again. And
what's the bad news?
Well, no, the bad news is I don't think we can get any kind of real reform until that happens. Even though everyone is horrified by what they did last time, and remain horrified by what the financial system, Wall Street, is doing again. So the good news is we will crash again. And what happened in the 1930s was Roosevelt did everything immediately in the crisis. Okay? You didn't save the system and then try to reform it. No, you reformed it while you're saving it. And he didn't save everything. Half of all the banks are closed down permanently. So that's what we need to do. We need to be prepared, but I don't see how you can be optimistic about reform.
Éric.
Okay, so on the index itself and the construction, I don't want to go too much into detail here. If you want, we can talk. But basically, when you go cross countries, the base of the index will depend on the minimum value and the maximum value on different countries. And so that's why you can have, not have any cross. So take, for example, the liquid saving to debt ratio to construct a cross-country index. the minimum will be, say, US, okay, and you will take the value of France relative to the US. And so that creates a much lower value in terms of index for France relative to the US. But anyway, it's constructed like this. In terms of, that's also Felipe, how do you use the index? Okay, and what about financial innovations? And that goes back to Albert. I think practically, a lot of people, what they have tried to do is try to measure exactly stages of financial fragility. I'm quite skeptical you can do that from a macroeconomic perspective. Look at the debt service ratio. If you want to have Ponzi, finance has to go above 1. It will never be above 1. It was never above 1 in any of those countries. Okay, so what you're really interested is more trends of variables and how they move together over time. And so what I'm really interested, if I was a regulator and I had to do this, I would look at the trend of the index and say, there's something going on. Maybe I should look deeper into the balance sheet of the household and see what's going on in there. And so through that, we can partially capture some of the financial innovation, not all of them, through the, for example, the debt service ratio. Okay, will changes independently of the financial innovations. But you're right that, for example, look at France, they didn't have revolving home equity lending until 2006. So you would not have had that in the index prior to that time. So you could not capture this kind of thing. So that is just telling you that this index is not a substitute for good supervision at the macroeconomic level. It gives you just an idea of the overall trend of financial fragility in a sector or in a country. And then if you want to look deeper, you have to look on your own. Okay, and look at the practices of bankers, and their underwriting practices are extremely important. That's what you really need to look at. How do they make a loan, on what basis? Okay, and look at the product they put forward. Again, if you look at interest-only mortgage and pay option mortgages, those things have existed for a long period of time, but they were restricted to wealthy borrowers that could sustain the payment shocks, okay, of those mortgages. And then progressively, you could see that 40% of the mortgage originated through non-prime lender were interest only. Okay, and there's something going on there too. Same thing, subprime lending has been going on for a long period of time. I don't think that's dangerous in itself. Okay, what you really want to look at is the underwriting behind subprime lending. We know default rates will be much higher, but did the bank protect itself enough to sustain the default? Did they underwrite carefully to make sure you can pay based on income? That's really the questions you want to ask yourself. And so the index really is just looking at that, and it's not looking at that really carefully. It's just giving you a trend and trying to provide a clue that something is going on. If you really want to know what's going on, you will have to look much deeper. In terms of data availability, I definitely agree that what this exercise tells you is that we're lacking a bunch of data to be able today to make an informed decision regarding the existing financial fragility. And so that goes back to, again, to what Minsky was saying. If you want to reform banking supervision, one thing you really want to look at are cash flows. Okay? More important than just capital requirements or liquidity ratios. You really want to look at the sources of cash flows, the risk of position-making operations. And so you have to develop the data sets that are available for that purpose. And I'm afraid we don't have that much available today, except for the US, but even there, you could do way more in terms of learning how underwriting practices change over time.
A very interesting separation that Randall made between finance and financialization. when you talk about ninja loans, they are you're operating in a mythical idea that the banks, they made bad loans. But actually, the crisis was not ninja loans, but was Abacus and the CDS operation trying to get money against Abacus. So the loans are not in the bank anymore. There was a question yesterday about the size of derivative markets. They're far stronger than the spot markets. And I think that's the critical question today. We must face that. We have finance. We have a theory to deal with finance and the problems of finance. But we have another thing. That's the way the market operates. It was the thing that McKibben yesterday didn't include. Oh, we have macro, we have micro, but the financialization, we don't have this discussion. We had part of this discussion today, earlier, when the lawyers discussed it. But we economists, we are not introducing the incentives in this, I would say very provocative, the Akerlofian moments, the moments that people loot, the moments that people are trying to, as Randall said, defraud the customer. So that's my point, and that's my question for you to develop.
Okay, so my colleague Bill Black says economists won't discuss the F word, which is fraud, but also financialization. So this word financialization has been around for a while, but economists always dismiss the economists who use that word and talk about the financialization of the economy until now, right? So I think you're absolutely right that they confused all of this activity in financial markets as being providing finance. And part of the justification for freeing the financial institutions was to increase this supply of a supposedly scarce resource. Finance is not scarce, right? All it means is you have a financial institution willing to accept an IOU and issue an IOU. That's all it is. It's never a scarce resource. So all of those arguments that we need to, that Larry Summers, played a huge role. We need to free finance to increase the supply of finance. You free finance to financialize the economy. That's what we did, and then this is exactly the wrong path. I agree with everything you said.
Anyone else? Yeah, you have any?
Well, no, I just say, add on to what Randy said. You did it to pay the fees and commissions of the asset managers. This is what made overcoming rich.
Well, with this, please join me in thanking our panelists.